Welcome to the Steadyhand webcast. I'm Tom Bradley, President of Steadyhand Investment Funds. The purpose of the session today is to introduce you to the new manager of our small cap equity fund, Galibier Capital Management. Now, Galibier isn't a familiar name to most of you, I'm sure, unless you're a veteran of the asset management business or perhaps a passionate fan of the Tour de France. My guest today qualifies on both fronts. I have with me Joe Sirdevan, who's the founder of Galibier and will be the manager of our small cap fund. Now we're going to explore Joe's background, the team he's assembled, their investment philosophy and how they make decisions, and we may even find out where the name came from. Welcome, Joe.
Good morning, Tom. Nice to see you.
What about that name? What inspired that?
Well, you're right. Veterans and fans of the Tour de France would certainly recognize the name. The Col de Galibier is one of the highest mountain passes used in the Tour de France. And our motivation for naming the firm was that we are all avid cyclists. Some of us have climbed the Galibier several times. And we believe that investing is a lot like cycling. It requires determination, it requires patience and persistence, but also requires a strategy and a process. So hence we named the firm after this iconic mountain.
No, Joe, I've followed you for many years, both your cycling career and your investment career. But let's bring our listeners into the tent today. How did you start in the business?
I actually started, growing up, I spent a lot of time watching Wall Street Week with my parents, who were both very, very interested in the market. And then actually one of my grandparents was a stockbroker. So we kind of grew up in a household that was very interested in the market. But really, it was when I was in business school that I saw a television show called Adam Smith's Money World, which featured a profile of Warren Buffett. And this would be in about 1989. And at the time, I think Berkshire's stock price was about $4,800. It's currently about $230,000. So I was very, very struck, or Warren Buffett's investment philosophy and process really resonated with me. And I decided to undertake investment management as a career, and it's become my life's work.
Now, you started in the business at Ontario Teachers' Pension Plan. You and I have talked about this. Many great asset managers in Canada came out of Teachers. It was a great training ground. What did you learn there that sort of shaped your investment philosophy?
That's true. My first job out of school was with the Ontario Teachers, and that was just actually, believe it or not, starting up then. So there was about 10 people in the investment department. There's probably about 500 today. So it was an incredible place to work. I worked with some incredibly smart and experienced investors, and I learned a great deal. But I think the thing I learned most at Teachers was a focus on proactive valuation. Teachers was a valuation-driven organization, and the work we did there was to analyze companies and then try and value them. But we generally valued them versus the market. So it was more of a relative valuation approach as opposed to the absolute valuation approach that we now use at Galibier Capital.
So now you spent a bulk of your career at Jarislowsky Fraser, which was a large independent money manager. You were head of research for equities. You led the lead manager on the global or the North American equity mandates, I think it was. You know, after you left them in 2011, was it 2011?
That's right.
I know you had lots of firms coming after you to join them, but you chose to set up your own firm. Why'd you do that?
I always wanted to have my own firm, and there's really three reasons why. The first is that I wanted to create a platform for the best money managers in the country to be attracted to come and join and ply their trade. Secondly, I wanted to see if this common sense investment philosophy and process could work in a startup. Third, we felt that there was a big opportunity in running concentrated portfolios for institutions and for clients, because we felt that was an underserved part of the market and that all the big money managers were becoming very much index-like.
Joe, in 4 short years, you've assembled a really impressive team. We don't have time to go into each of their backgrounds, but maybe you can just paint a little picture of who you have around you.
Absolutely. We have some terrific partners, and we have a cross-section of some of the best money management firms in Canada represented at our firm. So we have folks from McLean Budden, from Invesco Trimark, from Siona, and also from one of my former employer, Jarislowsky Fraser. We have another one of my partners who's joined us recently. So the team is very strong, and we continue to have people banging on the door to come and join us because they're very attracted to two things: Number one, our investment philosophy and process. And number two, the fact that we demand that everyone at the firm have the majority of their personal investable assets in our products. So this gives these folks a chance to be absolutely aligned with the client.
So what about that investment philosophy? Give our listeners a bit of a description of how you're going to approach managing the small cap equity fund.
In terms of our investment philosophy, we are fundamentally driven bottom-up stock pickers. And to achieve this, we do two key tasks. The first is to start with the overall universe of securities, which number about 6,000 in North America, and whittle it down into an investable universe of about 450 ideas. We demand that for a company to have inclusion in our investable universe, it must possess 5 key criteria. The first and most important is an enduring and sustainable competitive advantage. And that can come from many sources. But chiefly it comes from brand power in a larger cap name like Apple, or in a smaller cap name like MTY in Canada, which operates about 30 restaurant banners in Canada, all of which you would know, names like Thai Express, Cultures, Country Style Donuts. Brand power is within MTY and makes that model a secular earnings and cash flow growth story. Secondly, it has to demonstrate a management team with a demonstrated record of success in maximizing that competitive advantage. Third, the company has to be generating a high degree of earnings and free cash flow. And by free cash flow, we're talking about cash flow from operations, so all the cash the company brings in, less the capital expenditures the company has to put out to support its growth. Number 4, it has to be in industries with above average long-term growth prospects. And finally, the company has to be generating these excellent returns with an appropriate level of financial leverage, so we don't take any balance sheet risk at Galibier as we put companies into our investable universe. Once the universe has been defined, we then seek to proactively value those companies using a rigorous valuation methodology.
Now, the tagline on your website, Joe, is growth at a reasoned price. And I think what that speaks to is how you pull that philosophy and put it into action. Am I right?
That's exactly right. The nuanced reasoned price is against the typical sort of investment moniker of a manager being GARP, or growth at a reasonable price. Because our real key secret sauce at Galibier is our valuation methodology. We spend a lot of time coming up with our view of where fair value lies in these companies that are in our investable universe. And to do that, we look out 3 to 5 years into the future. And because the companies that we're examining are secular earnings and cash flow growth stories based on their enduring competitive advantage, we believe we can look out 3 to 5 years, because these companies are inherently more predictable than the market in the whole. So once we look out 3 to 5 years, we seek to figure out where we think earnings, cash flow, and balance sheet structure will be in those companies. We specifically model that out. We talk to management teams, we talk to competitors, we talk to suppliers, and that gives us sort of the framework to do this type of modeling. And we come up with an estimate of future earnings, cash flow, and balance sheet structure. And then we try and estimate where we think the market will be valuing that company in 5 years based on a reasonable measure of valuation. So we're not making aggressive assumptions about future PEs, like price-to-earnings ratios or price-to-cash flow ratios. We're looking at all sources of value, both on the income statement and also on the balance sheet. So if a company's got a whole bunch of cash that builds up on the balance sheet, for example, we're going to input that into our future estimate of value, or price of the stock in the future. And then once we've determined what a stock's worth, let's say in 2021, we discount that back at a company-specific discount rate, which is between 12 and 15%. And a low-risk company like, say, the Royal Bank of Canada, we'd probably use a 12% total return hurdle. A higher-risk company, maybe a technology company, we'd be a little bit higher, maybe 15% plus. But either way, we get back to our view of intrinsic value today. And we do that for all 450 stocks in the universe, and then we wait for opportunities.
Now, Joe, I know you've always loved small-cap investing. Maybe you can just connect that with that philosophy and the team you talked about. How do they fit together?
That's true. I used to manage about $1.4 billion in Canadian small caps when I was at Jarislowsky Fraser, in addition to my other duties running North American equities. So it's always been an area of interest for me and also other members of the team. What attracts us to small caps is several things. The first is that smaller companies often have very high growth prospects. And because of our focus at Galibier on secular earnings and cash flow growth stories, we often find companies that meet those criteria in small cap land. Secondly, it's an area of the market that can't be exploited by the large institutions because they're so big that when they buy these companies, they can only buy a certain amount of them. It doesn't have much of an ability to materially impact their portfolios, so they tend to not play some elements of the smaller cap marketplace, leaving perhaps for inefficient pricing. And inefficient pricing is often due to the fact that a lot of small caps are underfollowed by the sell side of the street. So there definitely are often opportunities. And at Galibier, because we're focused on valuation, a lot of small cap names often pop up on our valuation screens in our work on 3 to 5 year earnings and cash flow because this growth may make the stocks look quite cheap versus their future earnings prospects, even though they might look somewhat expensive on current earnings because of the higher growth.
Now, Joe, if we can finish up by looking at the small cap equity fund specifically, what should our clients expect under your management? Previously, we had, it was very concentrated, 15 to 17 stocks. Our clients remember that. Looked nothing like the index. What about under your stewardship?
Well, we'll continue to maintain the concentration of the portfolio. At Galibier, we'll probably add a few names and probably take it up to the low 20s with respect to number of names. But in terms of our focus on steady earnings and cash flow growth stories, this means that we will probably own less resource or extractive industries than the index over time because those companies don't meet that criteria of steady earnings and cash flow growth. So we're going to own more steady growth stories as opposed to more cyclical names in the base metals or the forest products or oil and gas. But we'll continue to be undexed.
All right. All right. Well, thanks for this, Joe. We're thrilled to have you on board, and we look forward to working together.
Cannot wait to start. Thank you.